chat.
Just a bit.
Oh, there we go. Okay, can you hear me now? Okay. So, okay, Morgan, can you hear me all right? I just want to, yes, better. Okay, a little better. Okay, good. All right, thanks for inviting me out here today, Morgan. I appreciate that. And basically what I'm going to talk to you tonight about is what I like to call the powerful price patterns. I've got 3 price patterns that I use on a daily basis for not only day trading the E-mini futures market, but quite frankly, I use these 3 patterns when swing trading stocks, ETFs, Forex. I mean, I trade everything with these 3 price patterns. Basis of a lot of my trading, I mean, and I would say it's probably a 20th of what I look for, but I think these patterns will help you in your own trading. So obviously you need to understand, you know, the waves of the market, and you all are familiar with what an uptrend looks like, right? Basically higher highs, higher lows, right? And in a downtrend, you've got lower highs, lower lows. Pretty simple, straightforward, and elementary, right? But you need to first understand that. And obviously a sideways market where you've got relatively equal highs and equal lows. So a market can only do one of these 3 things at any one time, so you need to understand that. And to make it really objective, I'm going to show you just 2 moving averages, pretty basic, right? I use a 50 exponential moving average and an 89 exponential moving average to make it real objective. Let's take out the subjectivity and just take a look at these moving averages to define what the trend is. And then we're going to use the patterns I'm going to show you, and I'm going to, you know, give you specific trade setups that I personally look for on a daily basis, okay? So we're going to make it real simple. Yeah, pretty basic here. So let's just go right into these moving averages. So let's talk about these 3 price patterns in an established uptrend first, okay? The first one over here, all right, is what I call an outside vertical bar, a bullish outside vertical bar, right? The market must close in the top quarter of the range, right? And basically the market needs to penetrate through the prior bar's high and the prior bar's low, but it must close in that top quarter and exceed the range of the prior day completely. So for those of you that you know, prefer to use candlestick charts, I've also got a candlestick chart here, right? It's called a bullish engulfing pattern. I don't necessarily need to see the body take out the prior bar's high or low. I just need to see the wick. I mean, the highest high of the day and the lowest low of the day must penetrate through the high and the low of the prior day. In my eyes, that's, you know, that's an engulfing pattern, but it needs to close in that top quarter. So that's the first pattern. Then I'm going to show you some charts, okay, on all these, how to apply it. The second pattern is what I like to call a BOB, blow-off bar. I call it a blow-off bar, but you know, just shorten it up with a BOB, right? A lot of candlestick users like to call it the bullish hammer, right? This is where the open and close are in the top quarter of the bar's range, okay? So that's key. There's 2 key things here. The open and close are in the top quarter, and the range of the bar itself must be about 125% larger than the prior 3 to 5 bars. So you must have a larger range than what you've currently seen. So that's what I like to look for. And then the third pattern right here is the opposite of an outside bar or an engulfing pattern. It is the inside pattern, right? So typically the market's contracting when this happens, of course, right? The high is lower than the prior bar's high, and the low is higher than the prior bar's low. I love these little patterns, and if you've seen any of my daily videos that I do, you see me talk about this all the time, and I give out a bunch of trades as well. I scan the market nightly for these patterns and look for these patterns and narrow them down. So these are the 3 basic patterns, and again, we've got to be in an established uptrend, and the market needs to pull down into a logical support level. So again, to define that trend and make it as objective as possible, let's take out that subjectivity for the purpose of tonight's little presentation here. We're going to use a 50 exponential and an 89 exponential moving average. Now, I get asked this question all the time. Well, why do you use an exponential? Why not a simple or a weighted? I mean, look, at anything you use, whether it be weighted or simple or exponential, I don't really think any of the type of moving average you're going to use is necessarily better than the other. You just have to be consistent in the way you use what you decide to use, right? So if you decide to use a simple or an exponential, it doesn't matter. It's just you need to use it and be consistent with it, don't flip-flop. So I prefer the exponential because it weighs the most recent price action more heavily than the older data. So that's why I personally prefer that. So those are bullish, and these are the bearish for a downtrend. So what I just talked about, right, that's when the trend is up, making higher highs and higher lows, right? You're trading above both the 50 and the 89 exponential moving average. Now we're going to just flip this for a downtrend, market making lower lows and lower highs, right? So you flip it. So an engulfing pattern in this case is going to be bearish. It has to close in that bottom quarter, and the market must penetrate through the prior bar's high and low. It must exceed the high and the low and close in the bottom quarter. That's simple. Again, the second pattern is that BOB, but it's bearish. The open and close must be in that bottom quarter, or it doesn't fit within my criteria, right? Close and open in the bottom quarter. I mean, think about it. The market opens up, the market rallies intraday, and is able to somehow completely reverse again and trade lower and actually close near that open in the bottom quarter. That's, you know, that's a big event. If the market pulls back to logical areas, right? And in this example, right, the trend is down, the market's pulled up to a logical resistance area. Now, you might ask, well, do you only use these patterns in defined trends, up and down? Honestly, not necessarily. I use these patterns as well when the market is testing what I believe is a significant high or low. If the market's testing a prior high or low and I see one of these patterns, I'll look to take a trade, you know, counter trend, looking to try to pick that top or bottom, right? I'm anticipating a potential double or triple top or bottom. But in this presentation, I'm only going to show examples with trading with the trend with these two averages, 50 and 89. And again, that third pattern is that inside pattern. It's the opposite of an outside pattern, right? The outside pattern, you typically get a larger range bar, right? Because you got to take out the high and the low of the prior bar. Whereas that inside pattern, the market's contracting, right? The high is lower than the prior bar's high, and the low is higher than the prior bar's low. Okay, and I'm going to show you exactly. I'm going to give you entries and logical profit objectives on these. So, but I just wanted to first start off with showing you the three patterns, right? Three bullish price patterns in an established uptrend when the market pulls down in support, and three bearish price patterns when the market's in a downtrend and the market's able to rally up into resistance, okay? So let's go into the first one, right? The bullish outside bar, or the bullish engulfing pattern. Okay, a little bit more detail here. We've already talked about bullet point number one. Market must exceed through the prior bars high and low, right? And again, we're only really looking for these patterns in logical support in an established uptrend, right? So the market's already up, market's pulled back. So what we're looking for is for the market to take out the prior bars high and low, right? You see that? So your buy entry is either the close of the open the following day, once you see it close in the top quarter, right? If you want to be a little more conservative, wait for the market to actually penetrate up through the high of that outside pattern. Again, you'll notice that on all these illustrations, I've got two illustrations, right? Number one over here in a regular bar chart, and then over here is a candlestick chart. So it's really the same thing. I started trading back in 86, 87 with the use of bar charts. Never used the candlestick chart, but I know most people these days prefer to use candlesticks, so I use those in my presentations as well, and I do use them as well. Not all the time, but again, it's going to give you the same end result anyways. So you're looking to, this is the trade. So you're either buying it on the close of the open the following day, or as the market penetrates through the high of the bullish outside vertical bar. Your initial stop loss, the ISL, is immediately placed below the low of that bullish bar, right? Your profit objective is the actual range of that outside pattern. So take the high minus the low of the day, get the range, and add that range up from your entry. You're going to add it to your entry, and that is your profit objective, which is represented here in the green horizontal, okay? Over here, exact same thing. So that is the first pattern and how you use it. Let's take a look at a chart, the random chart here. The market is trading, making higher highs as the market is trading above both the 50 and 89 exponential moving average. Again, we're going to try to make it as objective as possible. You're trading above those two moving averages, right, with a series of higher highs like you see here, higher highs, and you're trading above those averages. Once that market pulls down from that high, you're looking for a price pattern, right? So the first one we talked about is that bullish outside vertical bar. And you pull back into these averages, went a little bit lower, but then saw an outside vertical bar closing in the top quarter of that range is very powerful. That is a signal where your initial stop loss would be placed below the low, and your profit objective would be at least the range of that outside bar. So you can take the high minus the low and add it to your entry. So if you entered on the close, great, you made money on the open because it gapped. If you didn't, like in a case like this, if you were waiting for the next day to open and take out that high, I would have missed this trade altogether because I don't trade when it gaps through my entry price. Then I either wait for the market to pull back where I would have entered anyways, or if it doesn't, I miss the trade altogether. So by entering on the close of this particular trade, you would have made money, right, on the open, and it would have hit your profit objective right in here. Okay, so let's just flip this example. Okay, so I'm going to show you the bear trap. Okay, this is another. It's the same pattern. It's an outside pattern, but the reason I'm going to include this pattern with the bullish outside is because it's happening at the same place on a chart, right? So the trend is up, right? The established trend is up. The market pulls back into a logical support level. So instead of getting a bullish engulfing pattern, you actually get a bearish engulfing pattern, as you'll see here. The market closes in the bottom quarter. But this is a great trade because it doesn't happen very often. When it does, it's like taking candy from a baby. It's a very powerful move. Again, the trend is up. The market pulls down off of a high into a logical support level here. But again, instead of getting that bullish engulfing pattern, you get a bearish engulfing pattern, right? So if you get that bearish engulfing pattern, what I'm looking to do in the next 2 days, or the next 2 bars, regardless, I mean, depending on if you're day trading or using daily charts or a bigger time frame, I'm looking to buy that market automatically as it penetrates up through the high of the bearish engulfing pattern. So right in here would be my buy. Now, you might be saying, well, what about that inside? Well, you got an inside pattern here. I'd be buying through that high, but we're talking about the bear trap. I call it the bear trap, okay? So again, it's occurring at a logical support level in an established uptrend where I would normally be looking for, a bullish outside vertical bar, a bullish engulfing pattern, but instead of getting a bullish pattern, it's actually bearish. So, but if the market is able to reverse and trade up through the high of that bearish engulfing pattern, this is my entry right here. That is a great trade. So that's a little, again, it's the same premise of the outside vertical bar, the engulfing pattern. It's just the opposite. You're still looking to go long if the market takes out that high. The only difference here is it's not bullish, it's an actual bearish engulfing pattern. But again, if the market does not move lower and it trades up through the high of that bearish engulfing pattern within 2 price bars, that is an automatic buy. So I wanted to add that. And again, when you go long above that high, your ISL, your initial stop loss, goes directly below the low of the bearish engulfing pattern, okay? And your profit objective, right, is the same what I just showed you in the last slide, and that is the range of the bearish engulfing pattern. Take that range and add it to your entry, and that is your logical profit objective. Okay. So now, so let me give you an example. So again, you're trading above both averages, right? It's objective, right? No subjectivity here in terms of determining trend. I wanted to make it easy. You got the 50 exponential here. You got the 89 here. The market's trading above those averages with higher highs. You hit this high, you start to come down. Actually, I don't have this marked up. You got an inside bar. Now, I know I'm jumping ahead of myself just a little bit, but I've already talked about that inside vertical bar very briefly. You had one here. If you touch that upper moving average, you created that inside pattern. As soon as the market penetrated up through the high of that inside bar, your long is right here. You would have made money there. And you'll see in the next few slides here when I talk about that inside pattern that all your profit objectives would have been hit here before the market coming down here and actually creating this bearish engulfing pattern, right? You have a bearish engulfing pattern, right? Took out the high of the prior bar, took out the low of the prior bar, closing the bottom quarter, It's in a logical support level, right, back between the 50 and the 89 in an overall established uptrend, right? So again, within 2 price bars, if the market's able to take out the high of the bearish engulfing pattern, which it does, takes it out on the very next bar, that is your buy right there. Okay, so you're long there. Next day it actually becomes an inside pattern, right? The high is lower than the prior bar's high. The low is higher than the prior bar's low. Again, and that's one of my patterns as well. So as soon as the market penetrates up through that high, it confirms that the market should in fact move higher. Not only because the market did in fact take out the high of the bearish engulfing pattern, but you had an inside vertical bar. So you actually had 2 patterns combined side by side. And as you can see in this move here, the market made a pretty dramatic move once it took out the high of that inside pattern. So another good example here. As you can see, even without waiting for any of those patterns that I'm talking about in the presentation, you know, you had nice buying opportunities each time the market came down to those levels, even without waiting for them. So these are good patterns. They stack the probabilities in your favor. They don't happen a whole lot, but when they do, they are very powerful. Again, if you run a scan, you're going to find a bunch of these, and then you can read them out and try to filter out trades as well. So let's talk about, we talked about the bullish engulfing pattern. Let's just quickly reverse it for a down market. So the market's in a downtrend. The market pulls up into a logical resistance level. That's what we're waiting for here. So again, the overall trend is down, making lower lows, lower highs. Market finally hits the low, bounces up off that low, and creates a bearish engulfing pattern. Right? Again, market takes out the high of the prior bar and the low, and it closes in the bottom quarter. See that? It closes in the bottom quarter. So again, you either go short near the close or wait for the next day's open. It's really up to you. You can even wait for the next day to open. Maybe the market rallies a little bit. You could sell it there. Regardless of what you decide to do, your initial stop loss, ISL, needs to be placed directly above the high of the bearish engulfing pattern, okay? Your profit objective, again, is 1 times the range of that engulfing pattern. Again, take high minus the low. That's your range. Take that range, subtract it down from your entry, and that is your objective. That is your first objective, okay? So again, over here, this is a candlestick chart, just showing you the exact same thing I just showed you on a regular bar, right in here. Make sense? So right back. But again, remember, got to be an established downtrend, right? I.e., the market's got to be trading below both the 79 exponential and the 50 exponential, and the market must pull up into a logical resistance area. That simple. Let's look at an example there. So again, market's trading below both of these moving averages, right? Moves down in here. You see rallies up. First time you actually get one of these patterns right here, first circle here. Market takes out the high and the low of the prior bar, right? Closes in the bottom quarter, opens up next day. And as you can see, market makes a nice move to the downside. Your initial stop loss, your ISL, needs to be placed immediately above the high. And your first profit target, right? First profit target is the range of the bar itself, that bearish engulfing pattern, right? You take that range and subtract it down from your entry, and that gives you your first objective, right? There's a million ways to trail up a stop as well, and there could be a second profit objective. Let's say 1.5 times that range you could use as well. But a good starting point, first profit target should be the range of that engulfing pattern, right? And if the market hits, I would say 70% of your profit objective, I would move your stops to break even. Okay? Again, market makes a new low here, right? Takes out this low, rallies up, catch right in between the 50 and 89 exponential right in here. This is a resistance area, right? Looking for a price pattern. You see this? You see that bearish outside, closes in the bottom quarter, takes out the high and the low of the prior bar, closes in the bottom quarter. That is a short. That is a short trade. Place your initial stop loss above that high, and as you can see, market does exactly what you thought. So again, the reason I'm using that 1589 exponential is just to make things more objective. Make it real simple. You can use any moving average you want, but in this case, I wanted to use two longer moving averages, and so it works really well. Let's take a look at the bull trap, right? Okay, so again, we just talked about the bearish engulfing pattern. Now, what if Now remember, the trend is down, right? Making lower lows, lower highs. The market's trading below the 79 exponential and the 50 exponential, right? So it's objective. We know what the trend is. The trend is down. Market hits a low, bounces up to a logical resistance area, right? We're looking for the market to come into resistance. We would normally be expecting a bearish engulfing pattern or an inside or the BOB, right? But again, we're talking about the bull trap, which is simply an engulfing pattern, but instead of being bearish, it's bullish because it closes in the top quarter. It's that simple. So, okay, so it's in resistance, right? It's in resistance. The trend is down. The market takes out the high and the low of the prior bar. Okay, it's a bullish bar, but again, this is a fantastic pattern. If the market happens to reverse and it actually takes out the low of the bullish engulfing pattern within 2 price bars, boom, right in here where I'm circling, that is an automatic entry. You're short right here, and you immediately place your ISL, your initial stop loss, above the high of the bullish engulfing pattern, which I like to call the bull trap. Okay, so that's a great trade. Again, your profit objective, just like if you're going long or going short on a regular engulfing pattern, right, is the range of the engulfing pattern. So take the high minus the low, get that range, subtract it down from your entry. Okay, it's that simple. Let's take a look at an example here. And the trend is down, right? The market's trading below the 79 to 50 exponential. Market pulls up, goes a little higher than normal. Again, if you're into Fibonacci retracements at all, I'm a big Fib fan. You know, market comes up, trades down here. You get a, look at this pattern. You get an engulfing pattern. Once it actually takes out the low of that engulfing pattern, you want to get short. Even though this isn't a clean move, I mean, it does rally up. The price does rally up through the upper moving average, but not enough for me to say that the trend is up now. Not at all, because you're not making higher highs. I mean, you take out the moving average, you make another higher high, but you don't have a flow, a wave. I'm looking for that wave above the upper moving average or the wave below, right? You don't get that, so you come down off that high and create, you know, a bullish. Actually, this bar, I'm right here, paint number 1. That's actually a bullish engulfing pattern, right? So the bull trap, boom, right here, is it takes out the low. This is where I'm looking to go short right in here. All right, so not a clean move, but still a move that makes sense according to exactly what I just showed you. All right, let's talk about the inside pattern. And if any of you have watched any of my daily videos, you've seen me talk about that inside bar quite a bit. So again, an inside bar is the opposite of an engulfing pattern, right? The engulfing pattern, you need to see the market take out the high and the low of the prior bar. The inside pattern is just the opposite, right? The market's contracting. The high is lower than the prior bar's high, and the low is higher than the prior bar's low. I love these patterns because when the market contracts, it must expand, right? It must expand. So I love when the market makes a clean move down off of a high and an established uptrend into a logical support level, and then creates this inside pattern, right? Because I don't care where the market closes, okay? I don't care where it closes. I don't care where it opens either. All I care about is if this pattern is inside of the prior bar, okay? So what I'm doing here, my entry, my trigger is to go long automatically as the market penetrates up through the high of that inside bar. Okay, this is my buy point as it penetrates up through it, okay? My ISL, my initial stop loss, is directly below the low of the prior bar. Give it a little bit of room below the prior bar's low. And my first profit target is 2 times the range of that inside pattern, right? So again, take the high minus the low of that little tight inside pattern, times 2, get that, and add it up to your entry price, and that gives you your first profit target, okay? And again, if you come over here, if you prefer to use candlesticks, that's fine. It's the same thing. Your entry is when the market, your actual trigger is when the market penetrates up to the high of that inside pattern. As soon as you get filled, you put your ISL, your initial stop loss, below the prior bar's low, and your first profit target is 2 times that range, right? It's as simple as that. Again, my rule of thumb is if the market's able to get to at least 70% of your first profit target, you should move your stops to break even, so you risk nothing on the trade. I typically do that in everything. You know, the way I trade is, you know, you've got to be defensive. Once you enter the market, you've got to be looking to move that initial stop loss as quickly as possible when things make sense. So it makes sense once the market hits 70%, I move it. Okay? So trade management is very, very important. Okay? And again, when you enter the market, you absolutely, unequivocally need that catastrophic stop loss. And this is where I place my stop here. Let's take a look at an example here. So the trend is up, obviously, as you can see. Price is clearly above both the 79 exponential and 50 exponential moving average. It's a high right in here, pulls down, touches that upper moving average, right? Got an inside bar right in here, as you can see. Takes it out. That's my buy trigger to go long. My initial stop loss would have been placed right in there. If you take 2 times the range of that inside vertical bar, your first profit target would sit right in here with no problem. Market comes down a little bit further. I'm going to show you a loss here, right? Comes down. Remember, this is not as clean of a move as this first one, right? Got a nice big up move, and then a clean, crisp move to the downside. First pullback, once you hit this high, clean pullback down into the moving average. Inside vertical bar, popped up through it. Nice trade right here. Again, I'm showing you a loss here, the second one, but I'll tell you, just because, I mean, it wasn't as clean because look at, the market was not able to take out this high, right? It kind of failed in here. If the market had penetrated through this original high, then this would be a trade I'd be all over. But I wanted to point this out. It would have lost if you had taken this trade. But again, back to what I showed you on the very first slide. The market's got to be making higher highs and higher lows above both these 79 and 89, right? Right? So it didn't. It failed. The market was not able to take out this high here. Okay, so that, you know, again, it failed, but nonetheless, a small little loss. If you had been going long right in here, your stop is right in here. A little loss there. Markets between these moving averages here. Boy, this looks like an outside vertical bar. Took out this low marginally, took out this high marginally, closing the mid-range though. It was not bullish or bearish, pretty neutral. Now again, I do like to take these trades at times if the market is at a significant level, and it was between the 2 moving averages, right? Once it pops up through the high of that outside, your initial stop loss is below. The one thing I love about these patterns I'm showing you is your risk is very small and very defined, and your upside potential is enormous on these type of trades. So you made a new high. So let's just show you another example. Again, I got about 28 minutes before I hand it off to Doc, my partner in crime. So I don't want to go over. So I'm going to go quick here. Market, look at, made a new high. See, it made a new high here, made a new high here. Nice, clean, crisp move to the downside. You get an inside pattern right here. You see this, folks? Look at this. Inside pattern. Market takes it out. I'm long right above there. My initial stop loss is right down in here. Again, profit objective definitely hit right up in here. You take 2 times that range. Okay? Now, let me give you a little variation. Remember I showed you bull traps and bear traps to the engulfing pattern? Those were just slight variations of the engulfing pattern. I mean, not really a variation because they're still engulfing patterns. They just weren't bullish or bearish. They were in the opposite direction of the trend. But again, I showed you that trade as it comes back up through that higher low. So this is a variation of the inside pattern, right? And the only variation here is what I like to call a tight little inside vertical bar. Whereas what I showed you just a minute ago here, see this inside pattern? See the high? The high is lower than the prior bar's high. The low is higher than the prior bar's low. It's kind of, within the range, right? Whereas what I'm showing you here, the reason it's a slight variation is it's small. It's actually, this inside pattern is actually occurring in the bottom quarter of the prior price bar's range. Okay, which is very powerful. The smaller the range, that inside pattern, usually the more powerful the move it is. Okay, so and especially when you're buying the market in an established uptrend into a logical support level. Okay, and it's in the bottom 50% of the prior price bar's range, like it is here. Once that market pops up through the high of that inside pattern, I love those trades. I'll take them all day long, okay? Again, your initial stop loss, your ISL is placed below the low of the prior price bar. And on these trades where that range is so tight, instead of looking for a 2 times profit objective of the range, I'm looking for 3 times the range of that inside pattern. So again, take the high minus the low, get that range times 3, add it to the entry. That's my first profit objective. Again, same rule applies. Once you get 70% of your profit objective, I would move my stops to break even. Make sense? So if you look over here, it's the same scenario, but on a candlestick chart. Again, just a slight variation of the normal inside pattern. That range is in the bottom quarter of the range of the prior bar. Let's take a look at an example here. Again, look at this example. Trend is up, okay, makes a high, pulls down, pretty much touches that moving average, create a tight little bar. It's in the bottom half of the prior bar, pops up through it. All your profit objectives easily hit to the downside. Makes a new high, comes, I know it failed here. It did. And it came down, penetrated down through the lower average, and you had an inside pattern again. The reason I used a dotted little oval shape here is because the market didn't take out this high, so it didn't really fit within the criteria of making new highs, but still, it was a winning trade. I showed you a losing trade on this. This happened to make money. Again, if you decide to take a trade like this, no big deal, because you know your initial stop loss is below the prior bar's low. So on something like this where the market's been trading above those key averages, the 50 exponential 89, I mean, your risk is low and the upside is really unlimited. Unlimited upside with a very limited downside, okay? So I hope that helps a little bit there. And then let's just reverse what I just talked about. Now we're talking about a downtrend, okay? Again, we were talking about an established uptrend, right? Market pulling down into support. Now we're just going to flip it over to the other side. Market's in a downtrend, making lower lows, lower highs. The market hits a low, bounces up off that low into a logical resistance area. You get an inside pattern, right? In a case like this, again, I don't care where it opens or closes. I could care less. All I care about is if the market's able to penetrate down through the low of that inside pattern, right? That's my trigger to actually go short. My ISL, my initial stop loss, is directly above the prior bar's high. My first profit target is 2 times the range of that tight little inside pattern, okay? That's simple. Very simple trade setup. Okay? So let's take a look at the chart here. So look at the trend is down. Market's trading below the 50 and 89. Pulls up. It takes out the moving averages by just a little bit. But look at this inside vertical bar. Okay? A very, very low risk trade. You go short as the market takes out that low and place your initial stop loss above the prior high. Now, depending on where it took, if it took out the low first and then intraday, it took out the high, you would have had a small loss in here, okay? So makes a new low here. Now look at, again, right in here, the market's not able to take out this low. So it's really up to you on whether or not you'd want to take this short trade as it takes out that the low of that inside pattern back to the averages. Again, your initial stop loss is placed directly above the high of the prior price bar, never hit it. So in this case, where the market did fail to take out that low, it was still a good trade. You can see that the profit objectives easily hit, made a new low, popped up. Look at this inside pattern right in here, took out the low, you're going short right in here, and the market makes a new low again. Make sense? Move on here. Now let's talk, we're going to flip it. We're going to use the variation of that inside pattern, right? Again, the variation is simply, it's a really tight range, and that inside pattern is in the top 50% of the prior price bar's range. Market takes out that low, you're going short. Your initial stop loss, your ISL, is placed directly above the prior bar's high, right? So your profit objective, instead of 2 times that range, you're going to use 3 times the range. So again, you're going to take the high minus the low of that inside pattern, times 3, get that range, and subtract it down from your entry price. Okay? Again, market hits 70% of your profit target. I would move the stops to break even, so it becomes a free trade. Okay? Again, right over here, same thing. That inside pattern occurs in the top 50%. right? Let's look at some examples here. Again, look at trend is clearly down, hits that low, rallies up. You get the inside pattern here, takes a couple bars, but you finally penetrate down through it there. That's your short. And look at, again, 3 times the range of the inside pattern. I can tell you right now, the profit target was hit right in here before moving a little higher and dropping even further. Okay. All right, let's talk about the BOB. Call it the BOB, blow-off bar. Okay. All right. Again, the blow-off bar. We're assuming that the trend is up. The market's trading above the 15 to 79 exponential moving average, right? Market pulls back into a logical support level. That's important, right? So again, it pulls back into a logical support level, i.e. the 79 to 89 exponential moving average. You don't get an inside or an engulfing, but rather you get a bar that looks like this, right? Open and close in the top. It's got to be in the top quarter of the range, open and close. So think about it. The market opens up, market sells off intraday, manages to completely reverse and close in the top quarter. That's pretty powerful. As long as that bar isn't logical support and the range of that bar is roughly, 125% the prior 3 bars range. It's got to be a little larger of a range. It means volume, volume picked up, and it looks like, again, blow off. Market kind of blows off some steam to the downside, closes higher. It looks like the market's going to move higher. So again, you can enter the market as the market penetrates up to the high of that BOB, that bullish BOB, or near the close, or if the market pulls back a little, you can get a little better entry. It's really up to you. But you have to keep in mind your initial stop loss goes directly below the low of that bullish BOB bar. Okay, so over here on the candlestick, excuse me, open and close in the top quarter, initial stop loss goes below that bar, and your profit, your first profit target, is just 1 times the range, the same as the engulfing pattern. Okay. Now you might be asking yourself, what? You might be asking, well, profit. You have other profit objectives. Do you use a trailing stop? Good question. Don't have enough time to go into all of that. I just wanted to outline this. Again, I'm giving you the patterns themselves. I'm giving you the catastrophic stop loss, the ISL, and I'm giving you a very logical profit objective, okay? And I'm giving you an area in which you would want to take your trade to break even, right? And that's 70% of that profit target, all right? Let's look at an example here. The market's kind of chopping around. Let's see, what am I showing you here? Well, yeah, I got an inside pattern here. The market's pretty much choppy in here, but the overall trend is up. Again, I like the clean, crisp moves down into a support. This really isn't a great example. This is a better example right in here. Let's just ignore it. Look at this. The market, by penetrating up through this high, is confirming that the trend is up again, right? I mean, even though the trend is still up, it's kind of in sideways, kind of consolidating here, taking a breather before it moves higher, right? I mean, you do have an inside pattern. It takes out that high. That could have been a good trade to the upside with a stop below here. Or you could have viewed this as a bullish BOB right in here, but the range of this bar isn't bigger than the prior, so that doesn't fit. But right here, NH stands for new high. When the market penetrates up through this high right in here, the trend reaffirmed itself by taking out that high, right? So the market pulls back. As you can see, right this bar is a bullish BOB. Perfect example, open and close in the top quarter. Below that bar, right in between the 79 and 89. That's a great trade. As you can see, it moves to the upside there. Okay, let's just reverse this quick. So again, the trend is down. The market bounces up off of a low into a logical resistance area. We're going to be looking for a bearish blow-off bar, right? Open and close in the bottom quarter, right? Open and close in the bottom quarter. I really like to see that the range of that bar about 125% larger than the prior bar. Okay. So it's a little larger range bar, and it opens and closes in the bottom quarter. All right. That is a short. Again, you can short it as it closes or the next day's open. It's really up to you, or if you're a little bit more conservative and you want to see follow through, you can wait for the market to actually penetrate down through the low of that bearish bob there. Again, your initial stop loss is directly above the high of the bearish blow-off bar, and your profit target, your first profit target, your first one, is the range of that bob. So high minus low divided by high minus low, get the range, subtract that down from your entry. That's your first objective. Look at an example here. Market comes down, penetrates down. Again, not a great example of a trend really changing from up to down, but what I'd like to see is if you get at least 3 price bars, as you see right in here, I actually had 4. If you get 3 or 4 consecutive price bars, trading completely below the lower moving average, like you do here, 1, 2, 3, 4, you could consider that as a changing trend from up to down. And if that's the case here, then you want to sell it at a pattern. And you got a bearish bob here, opening, closing the bottom quarter, go short, and you can see the market continues to move lower. All right, so let's just sum these up real quick, and I'll pass the baton off to Doc. Again, let's talk about those bullish patterns, right? You've got the bullish engulfing pattern, right? Or the bullish BUBOB, outside vertical bar, right? High and low exceeds the prior bar's high and low. It closes in the top quarter. That's your entry right there. This is your profit target, 1 times the range. Your initial stop loss is directly below the prior the low of that bar. That's the pattern. Again, the bear trap, again, the same thing as what we just talked about, but instead of getting a bullish engulfing pattern, you get a bearish engulfing pattern. As long as the market's able to take out the high of that bearish engulfing pattern within 2 price bars, 1, 2, boom. Your entry is when the market penetrates up through the high of the bearish engulfing pattern. That is a great trade. Again, it doesn't occur that often, but when it does, a very, very, very powerful move, okay? So be aware of that. Then we've got the opposite of an engulfing pattern, which is that narrow range bar, the inside pattern, okay? The high and the low are not able to penetrate through the prior bar's high and low. My actual trigger to get long is when the market penetrates up through, right, up through the high of the inside pattern. Again, I could care less where it opens or closes, could care less. My trigger rather is when the market penetrates up through that high. As soon as it's penetrated, my initial stop loss is below the prior bar's low. A lot of times if I'm swing trading this off of a daily chart, as soon as the market penetrates up through the high of that inside pattern, my stop will actually be below the low of that inside pattern. Because look, for me to get stopped out on an intraday basis, the market would have to completely reverse and take out the low, which would mean you would get an engulfing pattern on that same day. And engulfing patterns don't occur very often, anywhere from 9 to 12% of the time. So you're pretty much safe by placing that initial stop loss directly below the low of that inside pattern, as long as the high is broken first, okay? Again, first profit target is 2 times the range of that inside pattern, okay? And then the variation of that inside pattern is when you get an inside pattern that occurs in the lower 50% of the prior price bar, okay? Very powerful move. And in a case like this, my initial stop loss is directly below the low of the prior price bar. And again, my profit target is 3 times the range of that inside pattern. Again, once the market hits about 70% of my profit target, I move my stops to break even. All right, and then the last pattern we talked about, the BOB, the blow-off bar, the shooting star, some people like to call it, who use candlesticks, right? Opening, close in the top quarter, both opening quarter, right? Opening, close rather in the top quarter. So the market opens up, sells off, is able to reverse intraday, closes, manages to close preferably above the open, but still in that top quarter. That's a great trade. You can, buy it on the close or the opening of the following bar, or wait for a little pullback. What you have to understand, though, is that initial stop loss needs to go directly below the low of that pattern. And if you're more conservative, wait for the market to penetrate up to the high of that bullish blow-off bar. And your first objective, your profit objective, is 1 times the range of that BOB. And again, a little summary here for the bearish patterns in an established downtrend, right? You got the bearish engulfing pattern, right? Closes in the bottom quarter. Market takes out the high and the low of the prior bar. I know there's a lot of repetition here, but that's what it's all about. Understanding like the back of your hand here. So again, you're shorting that market as it closes, or the opening the following day, or wait for a pullback. It really, you know, it's up to you on how you want to enter it. But once you see that bearish engulfing pattern in an established downtrend, when the market rallies up into a logical resistance area, this is a good trade. Again, that initial stop loss goes directly above the high of the bearish engulfing pattern. A little variation of that is what I like to call that bear trap again, right? So again, the trend is down. The market is pulled up off of a logical, off of that low in that downtrend, right? So instead of getting a bearish engulfing pattern, you actually get a bullish engulfing pattern. If the market is able to penetrate down through the low of that bullish engulfing pattern at this logical resistance area in the downtrend, I'm going short. I'm going short as the market penetrates down through the low of the of that bullish engulfing pattern. So I call it the bear trap, right? So that is the short trade, or I call it the bull trap. Doesn't really matter what you call it. It's a bullish engulfing pattern in a logical resistance area in an established downtrend. So as the market penetrates down through the low, that's when you go short, and your initial stop loss is placed above the high. All right, so again, the opposite of an engulfing is that inside pattern, right? And then we got the variation. We talk about this, right? So again, I could care less where it opens or closes. All I care about is if and when the market penetrates down through the low of that inside pattern. The market's contracting, so to be logical, the market's always got to expand at some point. So when it penetrates down through that low, I am going short. My initial stop loss is going directly above the prior price bar's high, and my profit objective on this is 2 times the range of that inside bar. Okay. Again, the variation is when you get an inside pattern in the top 50% of the prior price bar. Right. It's a real tight range. As the market penetrates down through the low of that inside pattern, I'm going short. My initial stop loss above the high. And my profit target is going to be 3 times that range, right? So take the high minus low, get the range, times 3, subtract it down from that entry point, and that is what you get, okay? And then the BOB, okay? The open and close in the bottom quarter of the range, going short either as the market penetrates down to the low of that bearish blow-off bar or on the close. It's really up to you on where you want to enter that, but initial stop loss is directly above that high, and your profit target, your first profit target is 1 times that range. So again, if the market hits 70% of your profit target, I'd move your stops to break even. And that's really all I have. So I appreciate it, Morgan, for inviting me to come out tonight, and I'm going to pass the baton off to Doc Severson, my partner in crime here. So I can be reached at Todd. If you got any questions, I can be reached at Todd, T-O-D-D, at tradingconcepts.com. You can go to the website, as you see down here, tradingconceptsinc.com. So great. Again, if you've got any questions, just email me, and I will certainly get back with you. But definitely go to tradingconceptsinc.com and just put your name in, and you'll get my daily video. I've got others that put out some great content on a daily basis. And it'll definitely help your trading. You'll see me put on a lot of these types of trades in the live market environment. So